Welcome to Sectors Up Close. I'm Elena Casas. Today we're talking financials and my guest is Amy Kong, CIO at CI Barrett Private Wealth. America's banking giants reaped windfalls from higher interest rates in the first quarter, overcoming jitters around the failure of Silicon Valley and signature banks to book higher profits, even as they set billions of dollars aside in case loans turn sour. The Federal Reserve's steep interest rate hikes are, of course, still widely expected to lead to recession this year. But for the big banks, they mean net interest income has surged, in JP Morgan's case, by 49%. America's biggest lender booked a 52% rise in profits to $12.62 billion, while Citigroup and Wells Fargo also beat the street on Friday. But the S&P 500 financial sector is still trailing the wider market this year. It's down almost 4% year to date. To find out why, let's ask Amy Kong of CI Barrett Private Wealth. Amy, hi, thanks for joining us. Now, clearly the Fed's interest rate hike cycle is very profitable for the big banks. So why do you think their stock performance has been disappointing so far this year?
You've got a lot of concerns, as you've pointed out, that there's credit risk out there. Clearly, the Signature Bank, as well as the Silicon Valley debacle from March, really set off some alarms that the really rapid rise in interest rates is causing a bit of a consequence for the banking sector. Rightfully so, they bought bonds to try to be conservative, but those bonds obviously are sitting on unrealized losses. And so that's the kind of concern that we're now faced with. As JP Morgan's CEO noted, we are expecting that there could be more ramifications from higher rates. Some different corners of the market, whether it's commercial real estate, et cetera, those may unfold in the coming quarters. And I think the reason why bank stocks are not trading as well as the broader market is, again, reflective of some of these concerns.
If we drill into some of the comments we heard from those CEOs on Friday, how much signal did we see that they are looking to tighten credit going forward?
Yeah, I think the comments from last Friday, and just to be clear, they're coming from some of the larger money centers. So that's important to keep in mind. They've been more upbeat than expected, which I think is a reason why some of these banks rallied on Friday. I think what we should expect is, yes, liquidity should continue to be a focal point for some of these CEOs. They're likely to continue to build capital ratios. We're probably going to see slowdown, whether it's in the form of buybacks. And at the end of the day, I think that is really key for them. I don't think it was a panic mode, if you would, on Friday. I think it was really just understanding that the market is slowing. And again, given some of the challenges we saw in March, especially with some of the regionals, these money centers are doing the right thing. And it's really, again, keeping a conservative mode going into the rest of 2023.
We did find out on Friday that they've set enormous amounts of money aside for a rainy day. Are the banks being overly conservative?
They did build their loan loss reserves, but not to the extent that I think investors were expecting going into the quarter. So it was actually a relief point. I think it was prudent. I didn't think that, in some of the cases like JP Morgan or Citi, it was done in such a, way that would cause alarms across the entire sector or the entire industry. And so I think that was fair. I think what they've said continues to be true in the sense that there will be more regulatory oversight. It wouldn't be a complete revamp, as Diamond put in. I think that's the right word to use. It would just be a recalibration of what's already in place. And I think that's important to keep in mind. There will be more regulation over this sector, and we can certainly expect that over the coming quarters, whether it's from the Fed or even within the banks themselves.
More broadly then, how are you advising investors to approach the financial sector at the moment?
Sure. Valuations are cheaper for the sector, clearly so. It is reflective of some of the credit risks that I've mentioned earlier. And I definitely would not be using just cheap valuation to get into this sector. These are cyclical type companies, and we are in this business cycle where it is possible that a recession is looming, perhaps, back half of this year, if not early 2024. And so I would be cautious going into these banks. I think, certainly we have some exposure. We're leaning more towards towards the larger players, knowing that, Goliath is actually winning in this kind of play out. In terms of the regional players, we're looking for opportunities, but we're not really going head in at this moment just because there's probably a little bit more, in terms of shoes to fall. And we're seeing that this morning with Schwab and as well as State Street and some of these other smaller players reporting, and we're seeing that they are getting crunched, whether it's fees or deposits actually leaving. And so we probably would wait until that dust settles out a little bit before really getting into some of the smaller or regional players at this stage.
Well, thanks so much for that insight, Amy Kong, CIO of CI Barrett Private Wealth. And that's our roundup of the US financial sector. I'm Elena Casas, and this is Reuters.